Good afternoon and welcome, everyone. So today I'm going to focus on the financial statements. And my objective here is really simple, is to give you an understanding of what do the financial statements say to us as business owners? And more importantly, how can we use this information to grow our businesses? For those of you who haven't met me before, my name is Andrew Patricia, and I've always been a business owner. But for the last 25 years, I've been educating, training, and trying to inspire business owners to really build successful businesses that they love working in, businesses that generate profit. And I find that the financial statements often are part of the business that every one of us need to understand, but don't always understand. So let us speak a little bit about financial statements. And today I'm going to focus on three basic financial statements. And I'm going to show you basically what do they tell us and why they're an important part of our business. But just before I say that, I just want you to understand why we need to understand the financial statements. And as small business owners, why we need to understand it ourselves. Because many of us will have an accountant or bookkeeper or other financial experts that are there to advise and guide us. But really, at the end of the day, the more we understand, the better. It makes running a business just so much easier when you've got a basic understanding of the financial statements. And the advantage of financial statements is they tell us how the business is doing, and that's really the key. So think of it almost like a report card that measures, what are you doing right and what needs some improvement in your business. So this is why I think financial statements are very important. And for those of you that are existing businesses, every year, your accountant will produce your financial statements, which they send through to Revenue Canada. And based on that information, Revenue Canada will tell you how much income taxes you need to pay. So this is why it's really important, I think, if you have a basic understanding of the financial statements. Otherwise, we have the scenario that we're small business owners, we're paying taxes every year, and we have no idea how much we're going to have to pay, why we're paying them. Some of us think which is usually very common, we think we're paying too much. The two key financial statements that your accountant sends through to Revenue Canada is the income statement and the balance sheet. Actually, just before we carry on, let me just mention something, that I'm not an accountant, so you need to understand that. But I have an accountant in my business, and I work with small business owners all the time that are dealing with accountants. So I'm going to give you a perspective from a business owner. So really, what's important to us, not what's important to accountants or Revenue Canada, but what's important to us when we look at financial statements. And I'm going to discuss the two key financial statements here, are the income statement and the balance sheet. So let us start off by discussing the income statement. Actually, one of my favorite financial statements. Why? Because it tells me so much about how my business is doing, firstly. And secondly, it helps improve. Once I understand it, there are things that I can do that can improve the profitability of my business. So as a business owner, probably I should understand this financial statement quite well, at least understand what it says, and more importantly, how I can influence what's happening on my income statement. So basically, the income statement measures the performance of your business. So if I wanted to know, how did your business do last year, I would ask you for your income statement. It would list your revenue, your cost of sales, and all the expenses you incurred for the previous 12 months. And when I say the previous 12 months, I mean, if you're incorporated, it could be your financial year. If you're operating as a sole proprietor, it'll be your calendar year. So if you're a sole proprietor, it would have been 2021. If you're a corporation, it'll be your financial year. So it could be from the 1st of January to the 31st of December, or like in my case, in my business, it's from the 1st of August to the end of July. So my financial year is next month, and I need to start preparing for it. Your accounting system, so any of you that use accounting, A lot of small business owners will use QuickBooks, or they'll use FreshBooks, or they'll use Wave, or any one of those accounting softwares, Sage. Your accounting system can produce a report for you every month, or every quarter, or every year. It's really just a simple process. You or your accountant or your bookkeeper just go in, press a button, and it'll give you a report of how you did last month. It'll give you your revenue, your cost of sales, and all your expenses. And I recommend that you look at this on a regular basis. And for those of you that are not so financially literate, maybe you could discuss this with your accountant, that every 90 days or every month, you would look at how are we doing? How's the business going? Because if you know there's a problem, you can at least address it. But if you don't know, that is always my concern. The third thing about the income statement, it's a record of all your income and your expenditure. So sometimes people will call it a profit and loss statement. Some people will call it an income and expense statement. But basically, you know what? It's got all your income and all your expenses. If you really want to simplify it, that's probably the best way to explain it. It tells you, firstly, if your business made a profit and how much profit it made. Now, some years, which is very common in small business, we'll have years that we do not make a profit. And that's okay, as long as you know the reason. That is the key thing, is if your business did not make a profit last year and you've got valid reasons, I'm okay with that. It's when your business is not making a profit and you don't know the reason. That really stresses me out as a business owner, because what you don't know could be dangerous. The advantage is, if you do know you have a problem, you can do a whole lot of things about it. This is a statement actually that I didn't make it, but I've seen it around quite a few times on the internet, and I don't know who came up with, but I think it's just so appropriate. And the statement goes like this: sales is vanity. You know, all of us get excited about sales. You know, last year we did $100,000 or $20,000 or $50,000, $200,000. We get all excited about that. But the reality is that in business, profit is what we are in business for. And you must never forget that. Never, ever forget that. Sometimes we get carried away in the volumes we're selling and the money we have in the bank and all of those things. But really, at the end of the day, you want to build a profitable business. And never forget that is our ultimate objective. The ultimate objective in business is to build a profitable business. So having good sales, high revenues, all of those things are really, really nice. But really, at the end of the day, we're in business for profit. Now, what I'm going to do, which is probably the best way to, I'm just turning off my camera because I want to show you a income statement, but probably the best way to show you the relevance of the income statement is to look at one. So what I'm going to show you here is a regular business. And I just put in a bunch of numbers here. So these numbers really don't have too much relevance, but I put in a bunch of numbers here just to show you what an income statement would look like. So this is an example of this business. Last year, its revenue was, let me just open that up a little bit. Last year, this business made $432,000 in revenue. Is that good or bad? Well, we don't know, because we don't know how profitable this business was. Its cost of sales, or as a lot of you may refer to it, the cost of goods sold, were $216,000, giving us a gross profit in dollars of $216,000. So last year, this business made a profit of $216,000. Okay, that is before any of the expenses. So whenever somebody speaks about gross profit, that is what they are talking about. They are saying that last year, my business made a gross profit after cost of sales. So let's use an example. Let's say I was a retail store and I was selling blankets. I don't know why I came up with blankets, but let's say I was selling blankets. If I'm a retail store, I'm selling blankets. Last year, my sales of blankets were $432,567. The cost of those blankets, so the cost to my store, landed in my store, was 216,532. So I made a profit on the sales of those blankets of $216,035. Okay, that's all it's saying. That's all it is saying, is that it's showing me how my business did. So last year, I made a profit of $216,000. And then I had expenses. So I had expenses of $21,000 for advertising. My accounting fees were $1,500. My rental for my premises was $34,000. My telephone cost me $1,200. My employee salaries last year were $38,765. I took a salary as an owner of $36,000. My insurance costs for my business were $3,246. Stationery, $542. And as a business owner, you would probably have a whole lot more expense items. So why did I only put in 2, 4, 6, 8, 10 categories? Just so you could see it on one screen. So don't think that you have to put expenses into a specific category. Your accountant will categorize your expenses. Let's think of other expenses I'd probably have here. Probably have software and subscription expenses. I would probably have cleaning services, maybe security services for some retail business. I'd have a whole lot of different expenses. I haven't put those into this income statement on purpose, but just so you understand, the reason I've only got those line items is it's easier for you to look at. So last year, I made a gross profit of $216,000. My operating expenses, so we often call these our fixed expenses, were $158,972. So my total operating profit for running the business, revenue minus my cost of sales on my equipment, cost of sales of all the stuff that I sold, in this case, the blankets, less all the expenses, gives me an operating profit of $57,000. Okay. Then I've got equipment. So if any of you have equipment, it's really important that you have a list of all this equipment. Even in my business, I use a computer, I use a camera, I use lights, I use all those type of things. Those are all my equipment that I use to run my business. They're not expenses for my business, but every year my accountant will depreciate those assets. Okay. How does he or she know how to depreciate the assets? Well, they get this information from Revenue Canada. Revenue Canada tells them how much they can depreciate the assets. So let's use an example. This is a retail business. So let's say it's got lots of depreciation because it's got lots of assets. So last year's depreciation was $32,000. It had interest on bank loans of $6,543, giving us a total interest and depreciation of $38,000, giving us total expenses of $197,000, giving us a profit. So I'm sure you've heard the term EBITDA. This is earnings before interest, taxes, depreciation, and amortization. And if you haven't heard of this, don't worry about it. It's just that investors often speak about that. So that is profit before depreciation and taxes and things like that. So in this case, this business's profit before it paid any taxes was $18,000. Okay. If it's a corporation, it'll pay taxes in last year of 12.2%. There you go. So it'll be $2,259, and earnings after taxes are $16,260. Okay. This money, usually these small business will keep in the business, and then at any time, the business can pay this out as dividends. So there's an example of a simple income statement. So your income statement that your accountant produces at the end of the year will look very, very similar to this. You'll have revenue, you'll have cost of sales, you'll have all your expenses, probably more than I've listed here. It'll have earnings and depreciation, and it'll have profitability. So all of us should be looking at this every year. So at the end of the year, your accountant produces it. What I recommend to small business owners is soon after the end of the year, you sit down with your accountant and you ask them this very, very simple question. You say to them, how am I doing? That's what you want to do, is you want to say, how am I doing? And that is the most important question for me. The most important question for me as a business owner is, how am I doing? Because really, at the end of the day, on an income statement, these are just numbers. That's all they are. They're just numbers. Once you start analyzing, they become really, really useful information. So I'm going to show you, and I'll send through these templates after the webinar. So Chris, if any one of you want them, you can always message Chris and he'll be able to share them with you. But I mean, these are just common ones. There's lots of examples on the internet if you want. So let me show you the part that I really get excited. And this is where your accountant can really help you, is they can help you analyze this income statement, okay? So these numbers that I've shared here are exactly the same as the previous template, okay? So on the previous template, I've just copied these numbers across, and they show the revenue, the cost of sales, and the gross profit. Here's the most important thing. This percentage here, 50%, how did I get this number? I took the gross profit in dollars and I divided by the revenue, okay? To get this 5% here, I took 21,456 and I divided by the revenue. So the common denominator is revenue. So what are you saying in each one of these examples? What was it as a percentage of revenue? Okay. So in this example, this blanket business, and it could be a blanket business, could be a restaurant, could be a retail business, could be any type of business, really. What this income statement says that last year, 50% of my sales were gross profit. Now, this is where this number becomes really important, because I can have a discussion with my accountant. In my case, my accountant's name is Angelo. Let's speak about Angelo. Angelo and I would sit down and I'd say to Angelo, sir, what do you think? Is that 50% good or bad? And he might say, well, Andrew, based on other clients that I have that sell blankets, that percentage is a little bit lower. Okay, so it's a little bit low. Maybe say the industry average is 52 or 55. So what can I do about that? So there's a couple of options for me. Firstly, I can increase the selling price. Secondly, I can negotiate a discount with my suppliers, but at least I know what I need to do. Or maybe, for example, you're running too many promotions. So if you're running too many promotions, that has a direct impact on your profitability. So this is the information you can do. Otherwise, numbers on their own don't really tell you too much. Once you start looking at the ratios or the percentages, then you can really start operating your business better. So let's use an example. Let's say I reduce my cost of sales by a few percentage points, okay? Let's say I negotiate discounts with my suppliers and I reduce my cost of sales to $202,000, okay? So I've negotiated discounts. Let's just see what happens to your profitability at the bottom, okay? There you go. You see what happens to your profitability? It goes up straight away. And this is why it's really, really important that you understand that if you understand what these ratios are, you can do something about them. So in this case, for example, I can determine very, very quickly that I'm either undercharging for my product, or I'm paying too much for my product, or I'm offering too many discounts. So straight away, I've got information. And you don't even have to be, I mean, I'm not an accountant, and if you and I were sitting down analyzing your income statement, I could help you determine that straight away. I actually had a very good example. I had a business owner, actually in Windsor, Ontario, and she was an engineer and had decided to open a restaurant and was really, really struggling. And she said to me, Andrew, what do you think I should do? I said, I don't know. I don't think she was very happy with that answer. I said to her, but if you bring me your income statement, I will be able to look through the numbers and I will be able to tell you where your problems are. And because she wasn't making a profit. And you know what? I swear I spent maybe 15 minutes with her. And what I determined quite quickly was that her selling prices were too low. And then she said to me, how much do I need to increase my selling prices? I said by 10%. So straight away, we had information. And why could I give her this information? Because I looked at her income statement. I looked at her income statement. By looking at her income statement, I could determine where the problems were. So this is where an accounting person can help you. They can say, okay, for restaurants, the average for your type of business is 70% or 60% or 50% or 40%. Okay. So, and I'm sure some of you are wondering, what is the ideal profit margin? Well, it depends on your industry. I, for example, am mentoring a business owner that runs a fashion business, and her profit margin is 60%. And her accountant recommended she try and increase it by 10%. So I was having this discussion with her, and she said to me, you know, I don't really feel comfortable just increasing my prices by 10%. I said to her, you know, if I was you, maybe don't increase it by 10%, but maybe 5%. And I said, this is the perfect time because people know that things are getting more expensive. The price of gas has gone up. We've had a bit of inflation. So now could be the right time. But how did I know this information? Because she told me. She said to me, Andrew, my gross profit margin is 60%. I want to get it to 70%. The other thing you can measure are how efficiently you're spending the money in your business. So for example, in advertising here, I'm spending 5% of my sales on advertising. So this, again, I could have a discussion with my accountant or with other business owners. I could say to them, so what percentage of your revenue are you spending on advertising? Maybe a business owner will say to me 3% or 4% or 5%, whatever it is. Then I could look at my income statement and determine if my marketing is working really well. And if it's not working, I can take steps to address that. And that's the part I really like about these ratios, is it gives me information about how's my business doing. And I think that is the key thing, is I want to know how my business is doing compared to other businesses and situations like that. That's what I want to look at, because interest rate, I mean, percentages on their own don't mean anything. Once you start analyzing, they make sense. So for example, these are some of the percentages I would look at. I would look at advertising. I would look at my rental expense. Let's use that example. Let's say you speak to your accountant and she says to you that the average business like yours should be paying 6% of their revenue on rental. This would give you something to negotiate. You can then negotiate with your landlord and say to them, you know, the industry average for businesses like mine is 6%. I am paying 8%. Okay. And then you've got a negotiation tool. And also, you know, for example, if your ratio is 8% in this case, so 8% of my sales is going towards rental. If I know that, one of my objectives is to reduce that number. Those are things that I can control. The way I can reduce that percentage is by increasing my revenue or negotiating with my landlord. The other ratio that's very important for me as a business owner are my employees' salary. Actually, you could even negotiate with your employees based on that ratio. So let's say your employees come to you and say, you know what, I really want an increase. And you can say to them, you know what we're going to try and do over the next 12 months is improve our revenue, improve our profit margins, and based on that, we will then increase your revenue. But you can't just increase your salary. You can't just increase salaries for the sake of increasing salary. Tracy says here that landlords go by local price per square foot. You're right, Tracy. Most landlords will negotiate price per square foot, but it also depends on the landlord. Just keep that in mind. If you're living in a smaller town, in a smaller area, sometimes landlords will quote all-inclusive prices, okay? Obviously, it depends on the landlord. Bigger landlords will always charge per square foot, and then they'll also charge you for taxes, maintenance, and insurance. But again, depends on who the landlord is that you're dealing with. Roy says rent cost is before or after HST. Roy, in your income statement, it'll be before HST. And the reason is that HST is not an expense for your business unless you're not charging HST. If you do not have an HST number, okay, then you are paying rent plus HST. If you have an HST number, you are claiming the HST back. So what you do at the end of the month or quarterly or whenever you do your HST, this is what your accountant does. They take all the HST that you charged, less the HST that you paid, and the difference you pay over to Revenue Canada. Okay, so when your accountant submits your income statement at the end of the year, if you register for HST, they exclude HST. So great questions, and keep asking them, and I will try and answer as many questions as possible as I go through it. But there's an example of an income statement for a business. In this case, this is a sole proprietor. They pay, depending on the profits you make a year, you'll pay a percentage of that, and that's what it is. But the key thing here that I want you to get with this webinar is this curiosity about how does this influence your business. For those of you that are service businesses like mine, this is what our income statement would look like. So let's say last year I made $123,000 of revenue. I spent $1,200 advertising. My accountant fees were $50, and I'm just putting in random numbers again. Say I operated from home, so I didn't have rent. Let's say $1,200 was my telephone. And let's say I've got a part-time employee that cost me $24,000. Let's say I don't take a salary. Okay, I don't take a salary because I'm a sole proprietor. I take a draw every month, whatever it is. Let's say my insurance was $2,345. What else do we have? Stationery on the right line. Yeah, let's say stationery $546. Repairs and maintenance $2,000. I don't know, to repair some equipment. And let's say other expenses for my business. And again, I would put specific things like software, subscriptions, and things like that. Let's say there was $32,000. There you go. And the depreciation, because I'm a service business, will be less. Okay, so let's say there was $2,345 last year. Okay, then it'll give me my profitability. So there you go. My earnings after tax last year was $39,000. I have to pay $16,759 over to Revenue Canada if I'm a sole proprietor. But let's say I was incorporated last year. Let's say I paid 12.2% on my profits. Then I'd have retained earnings or profits left in the company of $49,000. There's an example of what you would do. If you're a service business, you would go through exactly the same exercise. You'd go through exactly the same exercise. You would sit down with the accountant and you would discuss these percentages. You'd say, so how did I do last year? And then they take this information, just change this, yeah. They take this information, and what they would do is they would discuss these ratios with you. They'd say, okay, your advertising was 1%, that's quite good. Accounting, that was quite good. Your salaries is 20%, that's good, industry average, whatever it is. But your other expenses here were a little bit too high. So these are the type of things you will discuss with your accountant. And this is why it's really important. So let me just summarize what I encourage you to do. Every single one of you on this webinar, doesn't matter how financially literate you are, what you want to do is at the end of every year, you want to discuss your income statement with your accountant. But I would recommend that once you start understanding, and some of you already are advanced, hopefully, that you do understand it. But once you start understanding it, what you want to start doing is you want to do this more regularly. That's what you want to be doing. So what should you and I monitor? As business owners, what should we monitor? If I was a retail business, I want to know my gross profit margin for my overall business. So often you will see business owners speaking about this. They'll say, last year we made a gross profit margin of 22, or 32, 72, 46, or whatever it is. Okay. Actually, accountants call it the gross contribution, which sometimes confuses me because different people have different names for it. But basically, this is your profit based on your sales and your cost of sales. So if you're selling a product, if you're running a restaurant, what revenue did you do last year? And what percentage of that revenue that you did was gross profit? Okay, and depending on the industry, and you can discuss this with your accountant, or what you can do is you can go onto the internet after this webinar and you can Google it. Revenue Canada publishes ratios and benchmarks for small businesses across Canada based on the averages for your industry. So you need to know your gross profit margin for your overall business. Then as you get more used to dealing with financial statements, you want to know it by department. So I was a retailer for 11 years. And for me, I always wanted to know my gross profit by department. I wanted to know, for example, was my bakery doing well? Was my meat department doing well? Was my produce department? So what I used to do is in my accounting system, I used to departmentalize my business, okay? So I was showing you an example of doing an income statement every year, but you can set up your accounting system so that every month it produces this document, your revenue, your cost of sales, and your fixed expenses. That's actually one of the reasons that your accountant, if you own a retail store, if your accountant asks you to take inventory, and the reason they ask you to take inventory is because your cost of sales is calculated on your opening inventory plus the inventory you purchased minus your closing inventory. This is why it's very, very important when your accountant asks you to take inventory that you do it accurately, because then this will give you a very good idea of how profitable your business was last year. So this helps when you feed the accountant the right information. Excuse me. You've heard the term probably from computers, garbage in, garbage out. Financial statements are the same thing. If you do not feed your accountant the actual information, they can't produce quality income statements for you. So it's really important that you give them information. And taking inventory is a very good example. All of you've seen this. You go into a supermarket and sometimes you see them taking stock and counting things or scanning products is usually them taking inventory. So you need to know your gross profit margin for your overall business and by department ideally. And I encourage you to check it monthly. The other thing you want to do is you want to monitor your expense ratio. Just like I did, I took my advertising and I divided by my revenue. I took my rent and divided by my revenue. So that's the exercise you want to go through. So you monitor these ratios. And then what you do is you compare them. So every year you can compare them to the previous year and you can compare them to your competitors. And this is where your accountant's going to really help you. The other thing you want to do is you want to set yourself targets. So when I was a retailer, I used to always set myself a gross profit target and then a net profit target, okay? In retail, in my case, business was very, very competitive. So our profit margins were about 23, 24, and I was always trying to monitor that. And then our net profit was about 10%. Actually, the average company in North America would make an average of about 10% net profit. So you want to set yourself a goal there. But let me just tell you a really important thing that business owners often don't realize. Is a lot of times business owners will give customers discounts. You've got to understand that if you give me a discount, you're basically reducing profit that you take home to your family. And never forget that, okay? So set yourself net profit goals. And before you offer discounts, always take that into consideration. The other thing you want to do is you want to compare yourself to other businesses. And again, this is where your accountant can help you, or you can do research online. You could see let's say, for example, I gave you the example of a retail store. I was in the grocery business. Our profit margin was about 23, 24. I would often discuss this with other retailers. Say to them, sir, what numbers are you coming in at? And then I'd know if I was doing well or not so well. So that's the one thing. The other thing I could do is I could improve the most profitable products in my store. So for example, if you go into your supermarket, you'll see at the cash registers, they often have candy because that's a very, very profitable product that they sell. Sure, somebody's asked me, do I have a spreadsheet showing comparisons of ratios year to year? No, but I could easily create one. What I would do if I was creating comparisons year to year, what I would do is, which actually your accountant does. Your accountant at the end of the year, when they submit your financials to Revenue Canada, they show the ratios. So let me just tell you something interesting that some of you maybe have not thought about, is Revenue Canada can tell if you are cooking your books by looking at your ratios. Just think of it. If your profit margin one year is 20% and the next year is 25 or 30%, Revenue Canada could flag this and say, there's an issue here. So great question. So you can do that. Your accountant can do that. They can even set it up in your accounting system so that you can compare income statements and their ratios year by year. And I encourage you to compare your ratios monthly and annually if you can do that. If you're involved in retail, I think this is very, very important. I was involved in retail for 11 years, loved it actually, but it was very, very difficult, very, very challenging because your profit margins are often very, very low. So what I would look at, looking at your point of sale system, is look at sales by category. So you know what products are selling really well and not what products are not selling so well. You can measure things, for example, sales per square foot. Somebody mentioned earlier on that landlords quote sales based on per square foot, but as retailers, we often measure sales per square foot. So let's say, for example, I do $100,000 a year and I've got 1,000 square foot. I divide $100,000 by 1,000 and that'll give me the sales per square foot. The other thing you want to measure is the average sales per customer. So at the end of the day, you do your Z reading. Most of these POS systems nowadays actually print that number. So they'll tell you the average sales per customer today was $17.42, whatever it was. What you should do is you should monitor that because based on that information, you can tell if your salespeople are selling really well or not so well. If you run an e-commerce store, it could tell you how effective your marketing is working. Because if your sales per customer is coming down, you have a problem. You need to learn how to upsell products on your e-commerce store. If you're a retail business, what you want to do is you want to use more prominent in-store displays to attract people to your most profitable products. For example, now it is strawberry season and berry season. You'll go into stores and you will see that they're putting on these big displays of berries. And the reason is that berries are more profitable than selling newspapers or selling magazines, selling bread. So this is why they put on these big displays to move the volumes and increase their profit margins. And also train your employees to upsell. I mean, every single one of you at some stage in your life, you've been into a coffee shop or a McDonald's or something like that, and you order fries and they say, order a burger and they say, would you like fries with that? That's basically what you want to trade. So what you want to do is you want to train your employees to upsell. And this is a really important thing that you do this, that you train your employees how to upsell, which will improve your profitability. So very, very often business owners will ask me, they'll say to me, Andrew, how do you make more profit in your business? Well, there's a couple of simple little ways that you can do it. Firstly is charge more. And I know some of us don't feel very comfortable with this, but we have to, especially now. I think now is the opportunity If you haven't increased your prices for a long time, now's the perfect opportunity to do it. The second thing you want to do is you want to try and focus on fast-moving, profitable items. When I was a retailer years ago, one of those products was charcoal. In the summer, we used to move big volumes of charcoal. But I used to like selling charcoal because it was a very, very profitable product. So that would improve my profit margins during the summer. The third thing is don't discount. Discount is a bad habit. Just be very, very careful of discounting. This is the way I want you to think of discounting, is that every single time you offer a discount, that's less money in your pocket and for you and your family. So always think about it like that. The other thing we can do to improve our profitability is reduce waste and shrinkage. So you've been into the local fast food place where they measure everything. They're making you a sub or something. They measure how much meat they're putting on. They measure how much cheese they're putting on. The reason is they're trying to reduce waste and improve their profit margins. And doing really simple things like putting security at your back door, making sure you've got cameras in store so that you can reduce the amount of theft. All of these things are really, really important as a business owner, because every time some wastage or theft takes place in your business, that's profit going out your back door. The other thing you want to do is you want to train your employees to be productive. You've got to understand that your biggest expenses in your business are your labor, your rent, and your cost of sales. Those are basically your three biggest expenses. So what you want to do is you want to control those. You want to control your cost of sales. You want to make sure that your employees are productive, and you want to negotiate a fair rent or increase your sales per square foot as much as possible in your business. The other thing you want to do is make sure that employees understand profitability. Because what I find sometimes is when business owners don't educate their employees, they just assume that everybody's making a lot of money because you're a business owner, you're very successful. When you start making employees aware of this, that every single time they waste, it has a direct impact on the profitability of the business and could potentially have an effect on their jobs, they become more aware of it. So when you pay bonuses, don't just do it on revenue, because then if I'm your employee, I'm going to try and get sales at all costs. But if I'm aware that it's going to be influenced by the profitability, I will not offer so many discounts. I will try and upsell. I will try and do those type of things. Sell added value by bundling. And many businesses do this. What they do is maybe they discount the one product, and then when you upsell it, I'll give you an example. I remember when I first moved to Canada, one of the first things I did was buy winter shoes. And when I go to the cash, the salesperson said to me, "Do you want a protected spray for that?" And I said, "Sure." I had no idea. And I think I used that spray once. But that's how the salesperson upsold me. He upsold me. I bought the protective spray for my shoes, never used it, but it increased the profitability. You can have a massive impact on the profitability of your business if you train your employees to upsell. I went to a coffee shop yesterday, for example, ordered a coffee, premium coffee, and the person at the cash said to me, we got some lovely banana bread. Why don't you buy a slice? I didn't, but that was good sales. There was really good sales because they were trying to upsell me to increase the sales per customer and the profitability. And the other very, very important thing is focus your marketing on profitable customers. This is what I believe is a business owner. It takes the same effort to sell $100 as it takes to sell $1,000. But very, very often, this $1,000 sale is more profitable. When we want to increase our sales, because remember, that is the key to making more profit in any business. Increase your sales at a fair profit margin, is keep your best sellers in stock. I've seen this many, many times, even with e-commerce businesses. They go out of stock all the time. I was having a discussion with the business owner last week. She was saying, well, we tend to go out of stock all the time. I said to her, that is a big, big problem. She's in the fashion business. Their lead times are 10 weeks. So if you can't get the product now, you have to wait 10 weeks to get it. That is a big, big problem. So just be very, very careful. Teach your employees, and I mentioned this a couple of times already, to upsell so that you can increase the average sale. So if a customer, think of it, if you've got 1,000 customers coming into your business and you sell them each $10 more, that's another $10,000 of revenue. Increase the number of items they buy by upselling. And again, you want to do it in a educational, polite, friendly way. Not a, you want to share the benefits of buying what you're recommending and increase the number of customers. All of these things are the way we grow our business. So if I want to grow revenue, I can increase my average sale, I can increase the number of items a customer buys, or I can increase the number of customers. So for some of you, just increasing the sales per customer makes you a more profitable business. For others, we need more customers. The next statement that you need to understand that I find a lot of people struggle, but I'm going to explain it to you today, and hopefully you will understand it much better. But the balance sheet, so the income statement tells you about profitability. The balance sheet tells you about the net worth of your business. What are your assets and what are your liabilities? So if you look at your balance sheet at the end of the year, it'll always say as at whatever your year end is. In my case, as at the 31st of July, these are the assets I have in my business, and these are the liabilities, which basically means this is all the things that your business owns, Andrew, and these are the things that your business owes. And ideally, the thing that you own needs to be higher than the thing that you owe, which is really quite obvious, but you need to understand this. So what I recommend every one of you do is at the end of the year, what I would say is start off by understanding the income statement. Let's say you're not good with financials at the moment. Start by understanding the income statement. Once you understand the basics of the income statement, the revenue, the cost of sales, the gross profit margin, the expense ratio, once you understand that, then move on to the balance sheet. So ask your accountant, and I recommend you do this. Ask your accountant to explain what the balance sheet says. And once you understand that, then you can start analyzing ratios. So let me tell you the reason for this. Is that often, if you're going to try and raise money for your business, that is exactly what your bank asks you for. Your bank asks you for your income statement for the last 3 years and your balance sheet for the last 3 years. And the reason they ask you for your balance sheet, they want to see what assets do you own in your business. So that if I give you a $20,000 loan and you can't pay it, do you have enough assets that I can attach to repay the loan? So that's the way banks think, because they're asset-based lenders. So often, the small business owners will approach the bank, will ask them for a loan, and they won't give us a loan, and we get frustrated. But the reason is that our balance sheet is not looking good. So it shows the net worth of the business. If you want to work out the net worth of your business, you take the assets the business owns, less the liabilities the business owes, and then you'll get the net worth. So it's really quite simple when I explain it like this, but people still struggle with it. So don't worry about it. So what I'm going to show you now is the information on your balance sheet. Let me just turn off this camera so I can look at these numbers. Excuse me. So this is a typical balance sheet. Most of you, when you look at a balance sheet, you want to have all these lines, and this part over here on the right-hand side will usually be under this part over here. The only reason I put it next to each other was so that you could see it all on one screen. Okay, but typically this part here would be over here. It wouldn't have all these fancy lines that I've put in, but that's really what the balance sheet would look at. So if this one looks a bit different, that's the reason, because I want you to see it. So let's go through this. There's assets and there's liabilities, okay? And then in business, we have things called current assets. Why do they call them current assets? I don't know. But let me tell you what current assets mean. Current assets mean that they change, okay? So they change almost on a daily basis. Think of it, your bank balance, your accounts receivable, your inventory, all of the three of these things listed on here basically change every single day. So where does your accountant get this information for your balance sheet? Your bank balance. you will, those of you that have accountants already that are in business, your accountant will always ask every year, they'll say, can I have your last bank statement so I can see your closing bank amount, okay? And that's where they'll get that information. So in my case, for example, let's say my accountant phoned me, and let's say I was a little bit disorganized. I would phone my bank and say, hi, on the 31st of July, which is my year end, what was my closing bank balance? I'd get that information, and then I'd put it into, I'd send it to my accountant, and he'd put it into the balance sheet. The next amount here is accounts receivable. So your accountant at the end of the year would typically say to you, listen, how much are you owed? What invoices are outstanding to you? Okay, we call those accounts receivable. So in my case, I use software to create invoices. So I would go through all the invoices that are unpaid. Okay, I'd go through all the invoices that are unpaid, add those up, and I would send it to my accountant. Okay, and my accountant would then put it into my balance sheet. Inventory at the end of the year, I don't have inventory, but let's say I did. My accountant would say to me, okay, Andrew, you have to count the inventory and tell us what the inventory is at cost on the 31st of July. So if I was running a restaurant, for example, I would count up everything, send it through my accountant so they could enter this information into my balance sheet. Okay. I also need it for my income statement. Okay? Because remember what I said, the cost of sales is the opening inventory plus purchase of inventory minus closing inventory. Then you'd have some long-term investments. Okay, let's say, for example, your business owns some property, or they invested in a GIC or something like that. You would put that into your balance sheet, but that number might be zero depending on the business. Then you have some fixed assets. Okay, so things like machinery, in my case, my computers and any equipment that I used to run my business, we call that fixed assets. Okay, so in my balance sheet, my accountant would have my fixed assets less my depreciation. Often they'll have a little note showing what the depreciation is. So they get that information. Where they get the list of all the fixed assets, I give it. My accountant says to me, what are your fixed assets? I send them a list of the fixed assets, the price I paid for that, and they will calculate the depreciation. Okay, so that's basically what you have on the asset side are these things over here. And really depending on your business, some of you might not have, maybe your bank balance is negative, okay? Or maybe you have no long-term investments or whatever it is. These would be things that would be relevant for your balance sheet. When it comes to this side of your balance sheet, your accountant would ask you, who do you owe money to at the end of the year? So they'd input that information. If you have a line of credit, so let's say, for example, I've got a $10,000 line of credit, but at the end of the year, on the 31st of July, it's at $6,422. The actual amount I would put into there, okay? If I owe any taxes, they would be under there. If I owe any HST, they would be in there. If I owe any payroll taxes, they would come under salaries and wages payable. So these are things that I owe at the end of the year. And these things change regularly. So that's why they call them current liabilities. Let's say I have some long-term debt. Maybe I have a loan of over 5 years, or I have a mortgage or something like that. My accountant would put it under this column here. And then the money that I invested in the business initially, the accountant would put under owner's investment or owner's loan or something like that. And then any profits that I keep at the end of the year after taxes in my bank account, we call those retained earnings. And that's how I run my business, for example. I'm incorporated. At the end of the year, I will, let's say I made $10,000 of profit. I will pay taxes, which is 12.2%. I'll pay $12,200 taxes on that. And then 12.2% of $10,000, which is $1,222. I would pay taxes. And then the balance, which is 8,780 something, whatever it is, I would keep in my business and we call those things retained profit or retained earnings. But let me use a simple example for you, just to show you why the balance sheet always balances. Let's say I'm going to start a new business, okay? My grandmother gave me $10,000, and I've decided I'm going to start a peanut business, okay? So I put $10,000 into the business's bank account, and we'll call this owner's loan, okay? We'll call this owner's loan, and the reason I call it owner's loan is because I want to call it owner's loan, okay? All right, so I put in $10,000 into my business. There you go. You'll see total assets of $10,000 and total liabilities of $10,000. That's why they call it a balance sheet, because it balances. All right, so now I'm going to buy a machine to make, let's say I'm going to start a peanut business. Did I say that already? And if I didn't, let's say I'm going to start a peanut business. And I'm going to buy a peanut making machine, and that's going to cost me $2,000. And the money is going to come out of the bank account. There you go. So now I've got a bank balance of $8,000, and I've got a machine that roasts peanuts for $2,000. Let's say I'm going to operate at the market, local farmers market on Saturday morning. So I take all of my money, my $8,000. I buy peanuts, salt, scoop to scoop the peanuts, packaging, all of those things. And it costs me $8,000, okay? $8,000. Now I've got no money left in the bank, okay? I've put it all, taken this big risk. I bought $8,000 of peanuts, and I'm going to sell that this weekend at the market. Anyway, so I go to the market, and it's wildly successful, wildly successful. I sell the $8,000 peanuts for $40,000. Peanuts are very, very profitable. So in my retail business, we used to sell peanuts. We used to put them at the counter, and people used to come in. They used to smell these fresh roasted peanuts, and they used to buy them. So there's a very good example. Anyway, so I sell all the peanuts for $40,000, and I've got no inventory left, okay? So I had $8,000 of inventory, and I sold it for $40,000. My profit was $32,000. $40,000 minus my cost of sales was $32,000, okay? And we call that profit, and after taxes, we call that retained earnings. So there you go. My balance sheet says $42,000 of assets and $42,000 of liabilities and equity. So let's use a couple of things that I do. Maybe I paid rent. Let's say I haven't paid the rent yet. I haven't paid the rent yet. I owe rent of $3,000, okay? So I owe rent of $3,000. There you go. So that's an account payable. So I would put that in there, okay? But basically what you can see is that, actually, let me just put that rent in. Accounts payable of $3,000, okay? And that'll reduce my profit, eh? So remember that. If I reduce my accounts payable, it will reduce my profit. There you go. So you see the balance sheet balances. Let's say I want to buy, I don't know, a new machine, okay? A new peanut making machine. All of these things have an impact on the balance sheet. But that's really what the balance sheet is. What is the net worth of this business? Basically, $39,000, okay? Because the total assets, total liabilities and owner's equity is $42,000. So this is what the owner is worth. So if I went to the bank tomorrow, they would look at this and say, okay, Andrew's looking for a $5,000 loan, and he's got equity of $39,000. Okay, we trust him to repay the loan, and if he doesn't, we don't have to worry too much because he's got assets that we can recoup. So what's the relevance of this balance sheet? Because the point is, producing the balance sheet is what your accountant does, but you as a business owner want to analyze it. So the first thing people that analyze a balance sheet would look at, so your bank, for example, let's say you were going to get a loan for your bank. From your bank, they would look at your current ratio. What that means is how liquid is your business. So let's give you an example. I remember in 2008, when we went through the financial crisis, a lot of the banks recalled the loans. So they recalled lines of credit. I don't know if they're going to do it again. I'm afraid of that, but I don't know if they're going to do that. But basically what they said, They said, listen, we're a bit nervous of your business. We're going to recall your line of credit and you need to pay for it. And the way we pay for it is by looking at our current assets. So your bank would do a calculation based on your balance sheet. They would take your total current assets, which remember was your inventory, your money in the bank, and your accounts receivable. They add that up, and then they divide by what you owe. And remember, what you own must always be higher than what you owe for a bit of security for the bank. So the bank will have a number that they're comfortable with, maybe 2 or 3 or whatever it is. I don't know. I'm just giving you random numbers, but that's what they would calculate. So this is why it's really important as your business grows to be able to get your accountant to analyze your balance sheet for you, so that if you want to sell your business or if you want to raise money, your balance sheet is looking good. The other thing that you could measure from your balance sheet is, remember I told you that on your balance sheet, you have your inventory. You have your inventory that you're going to count at the end of the year at cost. So I know when I was a retailer, we used to always calculate, we used to call it stock turns. And ours for my business was 12. So what does that mean? Let's say I do $120,000 a year, okay? My average inventory at cost would be, at selling price would be about 10,000. So 120,000 divided by 10,000 at cost, at selling, that'll give you 12 stock turns, okay? So basically, my inventory turned over 12 times a year. What does that mean? That if that number goes up, that's a good thing. My inventory is turning better. If that number goes down, that's not such a good thing. So if I was analyzing your balance sheet, okay, and I looked at your inventory turns and the industry average is 12 and you coming out at 8, what that means is that your inventory is not moving as fast as the industry average, which is a problem, because if I had to recall your loans, so decided I'm your banker, I want to recall your loans, maybe we couldn't turn that inventory to cash quite quickly, okay? And I'm trying to simplify this stuff as much as possible, but I want you to realize that this can get quite technical. But once you start analyzing it with your accountant, you will realize very, very quickly that this becomes really important information. Some of you maybe have read in the media that Target, for example, has been having a problem. What happened is during COVID, they overrid their inventory system and ordered too much inventory. Okay, so they ordered too much inventory. So what's happening is the inventory is lying in the warehouse. What are they doing now? Is they're running sales to try and get rid of that inventory. So this could be a big issue for a lot of businesses. The other one they have is that they measure is the debt ratio. That'll be your total assets divided by your total liabilities, to basically recheck if the business is viable. Please recap why owing $3,000 accounts payable and reduces the owner's equity. Okay, so the $3,000 accounts payable reduced the profit, not the owner's equity, but the owner's equity is made up of the retained profit plus the loan. Okay, so that is why, Camille, it reduced the owner's equity, because the owner's equity is made up of the retained profit and the loan. Okay, so in other words, before the rent was $3,000. Before the rent, the profit was $32,000. Okay, so once I included the rent, even though I didn't pay it, it was due. So I incurred that expense. So this is how it works. Let's say, for example, I go to a market and the rent is $3,000. That is an expense for my business. Doesn't matter that I haven't paid it. I have to pay it. So it's an expense. It goes in the income statement as an expense, which reduces your profit, which will reduce your retained earnings. Okay? Hopefully that helps you, Camille. And if you're not exactly sure, sit down with the accountant and say to them, no, I went to the seminar with this guy today and he showed me the rent, which increased the accounts receivable and increased the profitability of the company, which reduced the retained earnings. Okay. All right. So let me show you the last financial statement. Perfect. Hopefully you understood it. Let me show you the fast. Actually, this is not a financial statement, but I recommend to all business owners, and I believe we're going to have a webinar about this later on, and I'm going to show you exactly how to do it. But remember earlier on, I said one of the statements I made was that thing I put on the screen, and I said to you, I'm not sure who came up with the statement, but this is the full sentence. Sales is vanity. Profit is sanity, and cash flow is reality. One of the biggest challenges you and I are facing as small business owners currently is cash flow. Why? Let me tell you why. Firstly, every single one of us, our expenses have gone. Secondly, there's inflation. So what's happening is the cost of our products are going. Okay. So what's happening is, as a small business, you need to lay out money in advance before you sell something, which is a big problem, cash flow. So I always say to businesses that not only do you have to analyze your income statement at the end of the year with your accountant, or remember what I said earlier on, you're going to first do it at the end of every year. Then you're going to do it more often. You're going to do it more regularly. You can have a meeting, like in my case, I meet with my accountant every 90 days to discuss my income statement for the last quarter. That's what I do. Then what I want you to do is, remember at the end of the year, you're going to discuss the balance sheet with your accountant. But this part you have to do yourself, is with the help of your accountant or your bookkeeper, is create a cash flow forecast. Why? Cash flow is the number one reason that small businesses fail in Canada. Let me say that again. Cash flow is the number one reason that small businesses fail in Canada. So if you want to survive in business, you have no option. You've got to understand cash flow. And what I do every year, and I'm going to recommend you do, is in advance of my new year. So now I'm preparing a cash flow forecast for my business from the 1st of August, because remember, that's my financial year, to the end of July for the next 12 months to manage my money, because I don't want to run out of money. Doesn't matter that I've been in business for many years. I am paranoid about cash flow. So the first thing is, that's the main reason small businesses fail. The second thing is, it's your responsibility. Really, at the end of the day, the buck stops with you. When you can't pay your employees, or you can't pay your suppliers, or you can't pay your rent, you know what? Nobody feels sorry for you. They want their money, and it becomes your responsibility. And the other thing, which is a big, big thing, so let's go back to the financial statement. So I look at your income statement, it says, you know what? You are a very profitable business. But if your customers do not pay you on time, you know what? You don't have money in the bank. You could go out of business. So even profitable businesses go out of business. So this is why I want you to understand that each financial statement that I'm speaking about is very, very important for you. The income statement tells you how you are doing. The balance sheet shows your assets and your liabilities, the things that you own and the things that you owe. And if you want to raise finance for your business, your bank is going to ask for your balance sheet. So this is really, really important. The cash flow talks about the future, the inflows and outflows of your business over a specific amount of time. And I think this is really, really important. So JD says paying rent reduces the cash on hand, but there is no asset for the money paid, so it reduces the equity or it reduces the profit, JD. You're right. So in my example, and remember, let me just say something. I used a very simplistic example on purpose. I could have created a very complicated balance sheet, but I didn't want to create a complicated balance sheet. I mean, I could have shown you the income statement and the balance sheet at the same time, which, Camille, would probably have been a better idea, but it is what it is. We've got one little screen that I'm working on, and we've got a limited amount of time. But you're right, JD, that the paying the rent reduces the profitability of the business. It's an expense. Okay, so you got revenue in this business case was $40,000. Okay, revenue less the rent, which reduces the profit in the business. Okay, so understand that. So you got revenue less the cost of sales, which was the peanuts for $8,000, gave you $32,000, less the rent of $3,000, gave you $29,000. So if you were doing an income statement, that was a very, very simple income statement. Remember, I didn't even put taxes on there or anything like that. And I did that on purpose, just so you know, because I didn't want to complicate it. But you're getting the basic understanding. And the fact that you're asking questions really excites me, because now you're trying to understand it, which makes me really happy. So I'm going to show you how I do a cash flow forecast every year for my business. I keep it really simple. And the reason I keep it really simple, I think, is I'm a really simple person. I don't like fancy stuff. So let's say I was doing this for my business. I would start in August. Okay, so the 1st of August, and then I go through the whole year. Okay, and then what I do, the first thing I do is I do a forecast of sales. Okay, so I do a sales forecast. And where do I get this information from? I get it from previous year's numbers. So I look at last year and I say, so how did we do last year? How do we do the previous year? And then I'll input a number. Okay, I might say, all right, I think I'm going to do $12,500 in August. There you go. Okay, and then I'll go through September and I'll say, okay, but September's a little bit better month. I think I'm going to do $14,000 in September. And then October is small business month in Canada. I think I'm going to do $16,000. There you go. And then November is not as good as October. I'll do $14,000. Okay. And then December, it's going to come down. I think I'll do 10. See how I go through this process? And this is the way I do it. And then I have a cost of sales in my business. I'm a service business, but let's say I sold product. I'd put in the cost of sales, maybe as a percentage. Actually, I could do that. I could say C6. And remember, we're going to be doing another webinar on this topic, and I'm going to do this exact exercise for you. So I encourage you to sign up for that one. There you go. So let's say the cost of sales is 30%. I would put that in there. Okay. Then I'd go through all my inflows. So let's say, let's use this example, cash sales. Okay. Let's say all my sales are for cash, just for simplicity's sake. Let's do that, C6, there you go. So I put in my cash sales. If I get any loans for the business, I put them in here. So if I got a loan, if I got any grants for the business, I'd put that in there, because these are inflows into the business. If I gave the business an owner's loan, I would put that in there, okay? And then what I do is I would go through all the outflows. So I'd go through my accounting fees. And again, depending on your business, I'd go through all my expenses, B for bank fees, C for consumables. You know what I'm saying? You go through all your expenses, insurance, travel, salaries, because these I know in advance what these numbers are, and I would input them all in there, okay? I'd input the numbers. Let's say that's $150 a month. Let's say bank fees of 45. I'm just putting in a couple of examples here. Consumables of $450 a month. Let's say insurance is $234. Travel is $450. Salaries, let's say $4,500. And you keep putting expenses in here. So that's the way I do it. And then I just copy it across. There you go. And make adjustments for different seasons. And then I put my opening bank balance in here. So whatever it is on the 31st of July, let's say I've got $342 in my bank statement. And then I do a cash flow forecast. That's what I do. So basically, those are the three financial statements. Number one is the income statement, which shows revenue, cost of sales, gross profit, and then all the operating expenses. The balance sheet shows all the assets and the liabilities. The cash flow forecast is what I project is going to flow into my business out of my business over the next 12 months. And remember, I'll do it for the full year. I just didn't finish this off here. I'll put all the expenses, and then it'll tell me at the end of the month what my bank balance is going to be. Okay, projected, not actual, projected. And then what I like doing is that at the end of every month, and I recommend all of you do this, just copy what I do, is at the end of every month, I will take out my bank statement and I'll put the actual numbers. What was the actual sale? What was the actual cost of sale? What was the actual cash sale? Did I put any loans? I put the actual entries. And where do I get this information from? I get it from my bank statement. It's the inflows and the outflows are my bank statement. So what I do is I put this onto my cash flow forecast at the end of every month. So I create a forecast, then I create another blank one where I put actuals, and then I adjust. Because let me just say something to you. I am paranoid about cash flow. Why am I paranoid about cash flow? I've been in business for over 30 years, and the biggest problem I've had in those 30 years are cash flow. That's the biggest problem I've had. The nightmares in my business have been cash flow. So I'm absolutely paranoid about cash flow. Okay. So the end of the year, I like to speak to my accountant about my income statement, and then I do it every quarter. I discuss my balance sheet with my accountant, and then every month I update my cash flow forecast. I believe if you do those things, the chances of you succeeding are much, much better. Okay, so what I'm going to do is I'm just going to summarize what we discussed today, and then I'm going to open it up for questions. I'm going to leave a few minutes at the end for questions so that I can answer your questions. Here's the most important thing. Understand the important financial statements. If you have a basic understanding of what I shared with you today, the income statement, the balance sheet, and the cash flow, with a bit of guidance from your accountant or bookkeeper, I think you can build a successful business. But you've got to know these numbers. You've got to know those percentages. You know, am I making enough profit in my business? It's not just about selling stuff. It's about selling stuff and making a profit. So that's why you've got to understand your financial statements. Analyze your income statement. You can do it monthly, you know, and the more often you do it, the better it is. But some of you might say it's too much for me to do it monthly. I'd rather do it quarterly or annually. At least do it once a year and get advice from your accountant. What can I do to improve my profit? What can I do to reduce my expenses? What am I doing compared to other businesses? Those are the type of questions you want to understand. You also want to understand and manage the balance sheet. Balance sheet is never important until you try and raise finance or until you try and sell your business. One day you want to sell your business, somebody says, can we have the last three years income statements and balance sheets? And then they start looking at it and they say, no, we think you overvalued the assets, or where's all the profit gone? All those type of questions they ask, as they get that information from the balance sheet. I would also check the stock turns, there's a whole lot of ratios that they measure, but I don't want to discuss too many because I don't want to confuse you. I just kept it really, really simple. That's the other thing you need to know is in your cash flow, it'll tell you how much sales you need to generate to cover the outflows that you have every month. Okay. We've got two ways of doing it. You can use a cash flow statement or you can use the break even. I like using both, because the break even, you can do it on future sales, and the cash flow, you can do it on your projections. And here's the most important thing I say to business owners is keep learning, keep asking your accountant questions, keep asking your bookkeepers questions. If you don't understand something, ask the question. Don't be afraid to ask. Don't be afraid to ask, what does that ratio mean? Don't be afraid to ask, what is that benchmark? Don't be afraid to ask, is my gross profit high enough? What should I do? Should I increase my prices? Should I reduce my cost of sales? And I believe that everyone, if you take some of this information I have shared with you today, you can build a successful business. I want you to be successful. The way to be successful is to monitor your cash in your business, monitor your income statement, and make sure that when you need to raise capital, that your balance sheet looks good. So take this information, and build a successful business. Can you please turn off the recorder, Chris?